I think it is very difficult to be a public market individual stock picker in a world where the central banks are constantly meddling. Because when they do, the best thing that you can do is belong the market beta. And the more concentrated you are, the better returns you would have delivered since 2008, when the central banks started to get very aggressively involved. When individual stock pickers reigned the universe was when central banks were largely on the sidelines. And so there was all kinds of dispersion, right? Dispersion, meaning good outcomes, bad outcomes, lots of alpha, right? Meaning your performance was independent of the market. But since 2008, it's largely been beta that's driven the market. And the folks that have done exceedingly well were those in tech because we delivered the best beta. And every time we confuse alpha and beta, we get over our ski tips and there's always some big blow up. So I think my general takeaway is that if the central banks stay on the sidelines, individual stock picking reigns and active management can win. If they continue to be involved and do quantitative easing and all of this other stuff, index funds that are long concentrated market beta will always outperform in the long run. You have to have a sense of what's actually happening in the world right now. If you're just trying to deliver the market beta and run an index, then yeah, you're right. You should ignore this idea that there could be more price adjustments. But if you look at the public markets, which is again the ultimate terminal buyer, they have more cash than they ever had since 2008, which means that there is no reason to buy.
You're talking about private companies.
It all ultimately ends up in the public markets. And so if the public markets are saying there is no reason to buy this stuff, it trickles down. So then the crossover investor who has a public-private business says, you know what? On the public side, I'm completely de-risked and in cash. And so on the private side, I'll just be a little bit more circumspect and wait. As David said, I'll just wait 6 months and put even more money in later. I'll actually have a better IRR and I'll make the same profit dollars. So then the Series B and C firm who used to feed those deals to the crossover folks are like, oh, well, if you're waiting, I don't want to have to write a check to support these folks. My whole point was to have you mark up the deal so I could raise a new fund. They slow down. And then that goes back to the Series A person who's like, well, wait a minute. You know, the reason I paid it at 50 pre was because I thought you'd step in and buy it at 100. And so then they slow down. So all I'm saying is, I think that we are at the point of the cycle where constipation is setting in. And this is why you're seeing such a downtick in deal velocity and dollars put to work. I'll say it even more. If you're a venture investor who took a longitudinal view on public market stocks and then have now seen 60 to 70% write-downs of those same stocks that you could have distributed, you should still have something to answer to. That makes no sense. It turns out that the skill of private market investing and the skill of public market investing are different. Even if all you're doing is delivering the market beta, it's still different enough.
We had this discussion last year. Remember, I was saying, should I distribute the shares of Robinhood? Should I hold them? What should I be doing?
Well, we told you to distribute.
And I distributed. I distributed everything, you know, and in terms of secondary, I feel particularly smart.
Do you feel like a genius now? Because your LPs should say, thank you, Jason. They should be sending you
some of them are saying that. What I feel smart about, I'll be honest, is we had, I think, let's just say, I'm making up a number here, 4 out of 5 times we were offered the opportunity to trim our positions in secondary with our winners from people who wanted to buy secondary shares. I did it probably 4 out of 5 times. And I'm just kicking myself I didn't do it the 5th, or I didn't ask if they would take more. Because my God, we were able to clear some positions at very high valuations that are now lower than that in the private markets and send cash to our LPs and get over our hurdles in our first 2 funds, which, I feel smart about.
I think that you should feel so good about that. That is really hard what you did. And I think people underestimate how hard it is. It is really hard to actually return more money than you have taken in. And by the way, it was hard in the last 10 years where we've had basically a massive up market and the 4 of us, frankly, benefited from the extraordinary luck of being in tech. I think that I have disproportionately benefited from being at the right place at the right time, backed by enormous amounts of central bank money. And so I think we all have been.
I was watching Warren Buffett answer some questions, and one of the questions, and this goes to the law of big numbers like BlackRock, he was saying, listen, the reason I did better earlier in my career than later in my career on a percentage basis is because I had a smaller amount of capital, and I was placing it on smaller bets, smaller ideas and themes. And then as I had a bigger chip stack, I had to find bigger ideas to put more money to work, and therefore more people were looking at those. And so those assets were not undervalued. And so I found that very insightful in terms of when you participate in the market. If you're trying to pick between very large bets like Coatue and TPG and Tiger were doing in the growth space stacks, like now everybody knows that these companies, everybody knows Stripe's a winner. Everybody knew Airbnb and Uber were winners, in the late stage of the private. Everybody knew Facebook was a winner in the late stage private market. If you're battling that out, Yuri Milner is going to come over the top and pay $2 billion more than you, or Masayoshi-san's going to pay $5 or $10 billion more than you. Where is the alpha there? Where is the gain?
The alpha's in the fees.
Okay, there you go. And so they were playing a different game. And I started trading this past 2 weeks because I've never traded public stocks and I wanted to add it as a skill set. So I put a couple $1 million into an account, and I'm just trying to actively figure out how does value work there. And I'm just starting to make trades that I want to hold for 10 or 20 years. And we'll see if I can beat the market. That's the other thing is, what do you want to spend your life doing? If you can put money in a passive index and not do any work, well, that's attractive as well. So Sachs, what do you think in terms of active management, in these public markets and the size of the bets that have to be
Like
made?
I said, I think it's very hard to beat the market consistently. I think it's a very tough profession. I'm sure there are people who can do it, but I don't know if it's easy to predict who those people are. So look, I think it's something that can be done, but I just think it's a tough game. I mean, what we do as private investors is a little different, right? Because not everybody is in a position to buy shares, right?
Yeah, you're not available to you. You don't even know the company.
Access is limited and information is limited. And in exchange for that sort of preferential access that we get, we actually have to do work.
A lot of work.
When you're a public investor in a company, Disney or whatever, you don't do any work. You're not involved at all. We do a lot of work for the companies, and that's why they choose us. And so it's not, you're not competing against the whole world. I think the public markets are just so competitive.
Are you tempted though, looking at these prices? And because I was looking at a company that was trading at 50 times revenue last year, they're raising again, they double their revenue. So now they're at 20, 25 times revenue. They're raising at last year's valuation. And then I looked at the public market comps and they're trading at 6 times. So now I'm like, wait a second. Obviously, the growth rates are a little different.
You got to look at the growth rate. You got to look at the growth rate.
The growth rate was the growth rate in this example was 3 times greater than the public market comp. So how would you assess that then?
Well, what we're seeing right now is that pretty good SaaS companies that are growing, maybe on a trailing basis, they grew 3x, and, prospectively, they're growing, call it 2.5x. They're trading right now, not trading, but basically deals are getting done at 20 times ARR. 20.
Which ARR? This year's? Current run rate?
Yeah, the current ARR.
Okay, you're not getting that bonus, here's your projected next year, we're going to give it based on that. This is current.
No. Current ARR is about 20, 22, 23 times ARR.
Down from what last year? 100?
Oh, it was 100 times was the rule of thumb.
Yeah.
So now there are some where deals are getting done in the high 20s, I'd say, or even 30, if you believe that by the end of the year it'll be more like 20. So, but I think the new levels are landing at 20 something times ARR.
Yeah.
Now, why does that make sense relative to the public SaaS companies? Well, like you said, the SaaS index is trading at roughly 6 times, but that's only 20% average growth.
Right.
And so, if you're growing 3x,
about 10 times the growth, right?
Right. And the high growth SaaS companies are trading at 7 times. That's for a 40% grower. We've talked about this before. So listen, if you're tripling year over year and you pay 20 times, that'll be a 7 times next year. But if you're growing 2.5, 3x next year, that's way faster. So I think there's actually an arbitrage there. I mean, this is why we like doing private SaaS investing right now.